Hey guys, I got Todd Franzway today, comes with a wealth of experience, also the director of Franzway Mortgage Brokers as well. Amazing company. Todd, great to have you on board.
Yeah, it's great to be here, Tate.
Mate, by the way, just enjoy today as well. I must admit, last time I did this podcast, I've been recovering from an ACL and it was going to be my first football game and I'd been training pretty hard. I was absolutely wrecked at the last podcast, so we'll keep it pretty relaxed today, mate.
Right,
and
very
I'm
good.
not as tired this one, so let's go.
Nice. We've had coffee too, so we're good to go.
Two hot topics today, Interest rate and the budget. And what's the date for the budget, Todd? What are we looking at?
Budget, I think it's the 12th or 13th. It's next Tuesday week.
Tuesday week, so it's coming up fast.
Like yeah, I think so. Something like that. It's coming up. Yeah.
And what do the tax reforms look like?
Well, there's a lot of a lot of talk around what the government might do in terms of capital gains tax for selling assets, negative gearing, whether that stays, goes. There's inheritance tax even. So there's a whole heap of taxes that they're tinkering with or removing. They could do a full tax reform. But the consensus at the moment is looking like capital gains tax, maybe the discount, reduced from 50 down to 30, 33%, something like that. So,
and let's just cut right through the fat with that because, like we're dealing with what is it in Australia, about 70% mum and dad investors, yeah? Yeah,
mum and dad investors with one property, about 70%, yeah.
So I got a property, hypothetically, mum and dad investor, I'm probably around that 55 plus mark. I'm thinking, all right, should I sell now? Should I, ride the storm? What should I do, Todd?
Well, look, the part of what they're talking about is grandfathering or meaning if you already own a property, that won't be affected by the new or incoming rules, whatever that might look like. So I wouldn't be doing anything if you've got an existing property. I'd wait and see what happens. There's no need to panic at this stage.
So don't freak out yet.
No, not yet. No, I don't think there's a need to freak out at all, really. I mean, there'll be ways and means to still move forward in life, regardless of what the rules turn out to be.
And there's got to be some time frames with this too, right? Like I don't think we're going to get lumped on in the next month. This is all changing either. I think we're going to get some breathing space.
Yeah, I think so. Normally they have a lead-in period or a notice period. So yeah, I wouldn't expect a sudden shock to the system.
Okay, so mate, young couple, let's flip it on its head a little bit. Just bought my first home about 2-3 years ago, built up a bit of equity.
Yeah.
Partner and I were excited. We're going to buy our first investment property. We're hearing all this feedback about this budget thing, and rates are going to go up too, which we'll touch on a bit later.
Yeah.
And I'm thinking, should I just sit in the back seat right now, or what should I do?
Oh, well, I mean, I don't think there's any reason to not act. I think property will remain, if you're wanting to invest, a solid investment vehicle, because remember the taxes across all assets, or they're talking about it. I don't imagine they're going to change the capital gains on property and not shares and not businesses or whatever, right? So I would, if you've got a plan, stick to the plan. Don't let the noise sort of distract you. So that's what I do. Yeah, and I mean, obviously yield has got something to do with when you're buying investment property. What do you think they're looking like, yields in our area on the Tweed?
Yeah, great question, Todd. And with these current climate that we're in, we're seeing quite easily and comfortably 5% yield at the moment on properties. Now, what's exciting with the rental market is that does compound over time. In other words, it goes up. I think that's exciting. And, if you're starting off with such a good baseline, it's almost covering the mortgage. We'll talk capital gains tax at the moment, and other things like that are quite negligible. Maybe that changes. We'll see how that plays out. Negative gearing, we'll talk about that in a moment, but there's still at the moment that negative gearing. So people are neutrally geared often on these properties straight off the bat, which is great. I mean, we've got buyers agents that scour all over the countryside just to find a property that's got those sorts of yields. So it's really exciting for us. Yeah. And I think there's a lot more investors looking at the Tweed as a real great growth area. We've got the same force trying to move into the Tweed Shire as what we've got on the southern Gold Coast. They're talking about 40,000 homes needing to be built there just to cope with what's happening in the next few years. Well, we probably need at least half of that in the Tweed, and we're literally dealing in the thousands. So It's exciting. yields are going to be stronger. And it's shown that over the last couple of years. I think the rental, and look, Kristen's better at it than me, but it's probably 12-15% increase in rental yields over that last sort of 12, 18-month period. That's extraordinary.
Yeah, absolutely. So why would you steer clear of that, So, yeah, for sure.
So I think that encourages the investors to come into the market, and definitely with the Southern Gold Coast at our doorstep and such great education, etc. I think it's a great opportunity.
Yeah.
Probably heading in from that other segue with negative gearing, obviously a big topic in this budget. Negative gearing might be abolished. What do you think about that? Do you really think they'll do it? What's your take on that?
Oh yeah, it's a hot topic, isn't it? I think they're going to play with it for sure. Whether it's abolished or not, I'm not sure. Yeah, it's tough. What about I think about why it was introduced, in the first instance, and I think you've got some insight on that in terms of why was negative gearing put into place.
Yeah, it's interesting, and everyone's got a perspective on this. And I had a lovely old gentleman recently share his take on it, that some of these taxes were originally introduced and, formulated obviously before the turn of the century to try and encourage people to buy property for investment purposes. And one of the reasons he believed was the case was because, and it is factual, I guess, that the government did stop building houses for homes in regards to, in the old term, the commission homes. These days they segregated into disability services and different community housing, etc., and have different context and labels within those groups. And so mum and dad investors were given some sort of tax relief to be able to buy investment properties and try and fill that gap that was missing in society. And I think when you look at the data, like we talked about it before, 70% of people are mum and dad investors. You're talking about the average Aussie having a crack out there and trying to help out their kids and probably give themselves a better lifestyle. I mean, they're probably the ones that probably need it the most. And, if they go out of the market, that's a big piece to fill for tenants. Where are they going to go if they get displaced, if those people sell?
Yeah, that's right. And then I guess I look at that and then go, well, where's the incentive for mum and dad investors to provide new supply? And supply is a massive issue in this whole pricing, or house pricing, price of housing. So the supply thing I think is super important, because if you boil it down simply, that's what's causing the issue. And I think they're trying to maybe fix the issue with tax as opposed to the crux of it, which is supply. So
would it be great in a hypothetical context that this big company is going to come in and buy all these investment properties and give rental relief for everyone? But I can't see it happening, Todd. So I don't know what the big pipe dream is, but it isn't coming.
No, that's right. So I think that'll be a time will tell when it comes to that negative gearing thing. But they seem pretty keen to move it.
And last time I checked, I don't think the government's got any extra money in the coffers for rental housing. So that's an interesting one.
Yeah, exactly right. That's exactly right. So I think they've maybe got a spending problem. But anyway, that's a whole nother matter, isn't it?
It is. I mean, look, we're very fortunate in the Tweed. We've got a massive population moving into the area. That certainly creates a bit of a bottleneck with a lack of investment housing. So always gives great opportunity for investors to come into the market, which is exciting. And tell us a little bit about the clients that you represent. I believe that's quite a big percentage for you in your company.
So we do. We have a whole lot of investors and owner occupiers across the business, but a big piece is investors, and we typically tend to deal with investors that are not looking for investments in areas that are typically heavy with investment, like CBD locations, etc. Because I think that's an area that might struggle a little bit with all these new incoming budgets and rules, right? So in our area, I think it's a great time for people to be investing. There's good infrastructure starting to be, or has already been input.
Hasn't that changed?
Mate, the last 10 years or more is solid growth. heap of infrastructure, more coming as well.
And just on that, Todd, sorry, but I know that for the listeners that don't know the area that well, name a couple of the big infrastructure changes you've seen in the last 5 years.
Well, the biggest has got to be the Tweed Hospital, Tweed Valley Hospital. I think it's the technical name or whatever. But I mean, that was contentious, but it's pretty amazing to have that like right on our doorstep, and that in itself has created some pretty good investment opportunity in the region. And so we've had a whole lot of road upgrades, school upgrades. There's a whole heap happening, and the King's Forest estate, which is just starting out now, but it's got thousands of new home sites to be rolled out over the next few years, or 20 years or so.
It's interesting you chose those two things too. So from a sales agent and business owner and directing the company for almost 20 years, the shift. So in the last 5 years, people coming in from the medical industry. So I've got international clients getting permanent residency to be able to work in these hospitals, buying property, doctors, specialists, nurses, you name it. It's amazing, all different faculties within the hospital. So it's really exciting to see. King's Forest is another huge development. I believe they quoted an approximate of about a $12 billion project, just to give some scope on a numerology number. Yeah. It's literally the same size as, I think they worked out, about 20 times the size of Salt, which is the new Kingscliff that was built. So, down where Mantra and all that is. So that's extraordinary to see a development of that magnitude, obviously in stages, going to go for a great opportunity. And what it does, it allows people to move around a bit. It's going to bring more investment to the market too. People love those new properties. At the moment, they get the negative gearing on that and the tax depreciation.
They do.
That's a key word. I wonder, tax depreciation, how much will that change, if at all?
I hadn't even thought of that, to be honest. That hadn't crossed my mind yet. But I guess that ties in with the whole negative gearing piece, right? So that, I think that's a wait and see. It's a bit early to tell. So we'll
you need new housing in the country. Do you cut the hand that feeds you? That's going to be an interesting one for the government, isn't it?
Yeah, well, I think I heard someone say the other day, if you want less of something, tax it. What are they doing? But I mean, I think over time there'll still be requirement, or people will still want to invest in property. I don't think it's going to change the investor psyche, and they'll find ways and means. I think we've discussed, companies trust structures, etc., different ways. So I think how people buy property will be different. I think who buys the property will change. There will probably be some more first home buyers enter the market, but
I hope so, Todd.
I think so. I mean, we still predominantly the Australian psyches to, have home ownership. There's other countries in the world that's not the case.
Well, I've got a 17-year-old, I've got a 25-year-old, and my 27-year-old just bought. So, look, definitely keen to see the young ones having a fair crack, eh?
Oh, look, me too. I strongly believe in home ownership, because I just look to, well, what happens when you're 75, 80, you're not working, but, you're still alive, you're still healthy. How do you pay the rent for 20 years after you've stopped working, So, for me, it's a security thing, and others are different. Like, there are people subscribing. You told me a story earlier about the younger generation. They're not subscribing.
Yeah, it's true. So, and there's no right or wrong. I mean, obviously we're pro-property and we love it, and we're in the industries that are in property. But, there's a whole generation now that have decided, for whatever reason, they don't want to participate in the property ladder, if you like. So they're looking at different avenues, and, they're obviously enjoying life as well. They've got a strategy there. They're investing in different areas. So they might, for example, might be Bitcoin, might be shares, might be some sort of other managed portfolio structure. So they're looking at different avenues, and they're not necessarily subscribed like we were to the property channel. And that's okay. Like, I don't judge on that. But I think the government isn't taking into context that that's such a big growing market right now. They spend differently. They don't have those costs. They're also not impacted with interest rates, which is probably a good segue on our next part of the chat today. And so, yeah, they might be impacted a little bit with a landlord eventually having to pass on those, those increases, but they don't pass to the same magnitude that the investor feels. So they're running a completely different market, which means they've got more liquid money on the weekends, which also stimulates an economy in a completely different way to what we've seen in the last 30 years. No one talks about it. Government isn't even taking this into account. If you've got a new economy, of course inflation is going to be different.
Yeah.
I think it's a good topic that's not discussed enough, eh?
Yeah, absolutely. That's it. And so I think that, they're using an old tool that's not really relevant to try and control that spending.
And look, shares isn't my game, and Bitcoin and all that. I have a little bit, I dabble a bit, but it's not my forte. I guess you pivot to your strengths.
Yep.
But I say all good on them. If they're going to launch a company on the side, and who knows, these days you develop an app or you launch something through TikTok marketing and bang, it goes viral and you make millions of dollars. Good on them.
Yeah, absolutely.
If they've found a different way to work the system, I'm all for it. And I think we just need as a government and as a country and have some understanding about how these things are changing. And I think it's a good segue into these interest rates.
Yeah. So that's the thing. It's pretty well common knowledge now that most people are saying, interest rates will rise next Tuesday and then possibly in the next meeting after that. And it's an interesting time because a lot of like you say, there's inflationary things causing inflation at the moment that aren't related to the interest rates or the people slogging it out that have got a mortgage. They're the ones that are going to pay more.
That's right. What percentage is that roughly, Todd?
Which is that?
The percentage of people in the market that have got investment properties in total?
Well, it's
that'll
30,
be impacted.
Yeah. There's about 35% of the population have a mortgage.
Oh, there you go.
So, there's 30% that own without a mortgage, and then the remaining, 30% are renters.
Yeah.
That sit in and rent the investment properties. So there's only this small percentage of the population.
It's about a third.
It's a third, just a bit over. And that's the working population that are, giving it a go. They're not the ones spending money creating inflation, right? So it's really going to be interesting to see, do the interest rates even do anything at all? Because it's fuel, it's red tape, green tape, whatever, to get new properties to market, etc. There's a whole heap of these issues that cause the inflation. I don't know that the interest rates will do much.
And then you've got petrol prices, obviously, that's definitely created some significant inflation. And at the moment, I think the government finally realised that they could remove their excise for maybe a month or two to give us a bit of relief.
Yeah.
Would have been nice a few months earlier, but they woke up eventually.
Yeah.
So obviously that's got to come back into play. Maybe after the budget too, it might suddenly just rear its ugly head and we're back to paying the 30 cents.
Yeah, although I don't know.
It's
pretty hard to know whether you're getting the discount or not. Really, at the Bowser, isn't it? It's a bit radical, those prices up and down.
Big cause for inflation.
Yeah, that's exactly right. And so that's why I say I don't know how interest rates can control that. That's a totally different factor altogether. So, I think it'll be interesting to see what happens there. Our Reserve Bank appears to be one of the most erratic in the world at the moment with, if we go back the last couple of years, up, down, back, and now we're starting to go back up again. So, we'll see. I don't think anyone can genuinely say where they're going to go.
What's your prediction, Todd? How many rates between now and the end of the year? What are you backing?
Well, I'm going to go with the consensus of 2, right? But I wouldn't be surprised if it gets turned on its head. I don't think that it will, but I would. Well, I'm telling our say first home buyers that are coming in, even investors when we're doing cash flow projections, like expect 2, maybe 3 for sure, and factor that into the numbers. So as a just in case.
I'm going to be aggressive and say 3, and I reckon they'll land that last one just before it's try not to impact that retail market too much for Christmas, because they don't like to fluff around with that when it gets close. I know they hesitate.
Yeah.
But I think they probably need to do some adjustments, and I agree. Like, is it even going to make one or two rate cuts might not, increases. Gosh, that was last year.
Yeah, last year. See what I mean?
the zigzag. But look, I don't know if one or two rates is going to be enough, and three probably to make a difference. But then, what sort of difference are they creating anyway?
Yeah, that's right. The only thing I can think is it's more of sending a psychological message. Like, oh, hang on, it's getting tough. Stop your spending. Because on the other hand, you got all the boomers that are. And I don't say that in a disrespectful way. My parents are there. I'm not that much younger, but they got a whole heap of money, right? Like, and as the interest rates go up, they got more money to spend.
Correct.
So
yeah, they're banking on the interest. That's for sure.
Yeah. And that's what's that? Nearly 30% of the population, right? So higher interest rates mean they'll just spend some more money.
Oh, we could easily be saying just the rate for that at 6+% for nominal amounts, like it's pushing that way. So it's on the cards, isn't it?
Yeah. So it'd be interesting, but I think we love our property and that's what we do daily, but. I think that would just continue on. I'm not seeing like a major event, a catastrophic event, particularly in our area. And I think I keep coming back to like, as long as we do our thing, we're in a good spot.
We are. And then you mentioned King's Forest before, but the speed at which they can build the houses and the timing with that is so delayed. And the developer's smart. Yep. He's not just handing out all the land straight away either, which would flood the market.
Yep, correct.
So, you've got good people. I think, is it Newlands running the
Stocklands?
Stocklands.
Yeah.
I better get that right on the chat too, by the way. Yeah, I should know that straight off the bat. I'm thinking of altitude.
Yeah.
So, you got Stocklands running King's Forest as well. So that's really important that they don't overcook it, because obviously they're probably one of the few that can. And release in stages. And I thought they've done a really good job to date. And to the crew clearly that are running that, I tip my hat off to them, because if we flood the market with that, it could cause a bit of angst. And it's doing enough to see a bit of stimulus in people, obviously selling their existing properties and building, and that's a big percentage of that as well, which is exciting. Turns over a bit of property.
We have seen a fair bit of that. The majority of the people are downsizers. Actually, they're selling bigger homes to go into there in a brand new, smaller dwelling, maybe closer to the water than they've been before. So
and some flatter blocks.
Correct.
You haven't had that in a Tweed in a while?
Yeah. That's right. Flat land. You're right. Hasn't been available for a while. So,
I think that's one thing that might make people nervous. For people buying in that sort of scenario, they're probably, even if before they were looking at bridging finance or other solutions to fund the build, maybe they're now thinking, I'll just sell, rent for a period, have my money in the bank to build, versus the bridging option, because once those rates creep up, it starts to get a little bit more, a bit sharp too.
Yeah, that's right. And like I say, the people that we've helped into there are downsizers, so they have got some surplus cash from the sale of their home. So they can do that. They can take their time. They can build what they like. They can rent for a while. So there's no pressure on them. I think there's some first home buyers looking in there as well.
Oh, wow.
So which is a pretty high price point for first.
How are they funding that? Have they got a bit of backing with parents, or how does that work?
Well, I mean, we haven't helped first home buyers into the estate ourselves, but more and more we're seeing gifts from mum and dad, and we're seeing guarantee loans.
Wow.
That is happening for first home buyers very regularly.
And look, do you mind as well, Todd, being an expert in your field there, what's the difference between a gift and a guarantee? How do they work? I'd love to get some feedback on that for the viewers, of course.
Yeah, okay, yeah. So so basically a gift is if mum and dad have got some money or cash that they are willing to gift. They literally gift the kids.
And what could that look like?
So often they're gifting them 20%.
Wow.
Which is eliminating lender's mortgage insurance, right? So,
wow. So $200,000 at $1 million.
Yeah.
Wow.
Big chunks.
Very generous.
There's a number of grandparents that are bringing the inheritance forward in terms of giving gifts.
Well, that's nice. At least they get to see some of the.
They get to see it. Yeah, that's right. So there's a fair bit of that happening as well. Yeah, and you know that. Yeah, so it's good. It is good to see. Guarantee loans, or if mum and dad have got, or a brother or sister, it doesn't need to be mum and dad, but a strong equity position in a property, they're able to effectively gift a portion of that equity, and so long as the first home buyers can afford the repayments, it's a great way that they can get in with having a much smaller and even no deposit.
So how does that work? What are they benchmarking that against, the banks?
The equity position?
Yeah.
Yeah. So basically they say, oh, you're buying a property, let's call it $1 million over there. We're going to register a second mortgage on mum and dad's home over here, 20%, $200,000. And it's as simple as that.
So as a mum and dad, financially, that doesn't impact me. I don't have to pay any extra or anything.
Oh, you got to be careful of that. Mum and dad don't make any repayments, but does it affect mum and dad's plans for either retirement, downsizing, things like that? Are they looking to sell their own home or do something there, or buy their own investment property? Because that's something that pops up.
So if I'm looking to sell or do something else, maybe look at it.
Maybe. I mean, there's other exit strategies that you could still do it. And then in a year or two or whatever down the track, and enact one of them and end up paying some mortgage insurance or something like that. So there's a few different ways out of it. It's not set in concrete.
So if mum and dad are, doing well, maybe they're running a business in the Tweed, and they might have an investment property themselves, and on their principal place, they've got a couple of kids. Yep. Can they do a guarantee for a couple of kids, or can they only do it once?
You can do it up to twice.
Oh wow! So if you've had extra kids and you've, got 3 or 4, it's limit is 2, is it?
And it's 2. Yeah.
I'm out there, mate. I've got
4. And that's a thing that often comes up is like, oh, if I do it for one, I can't do it for the others, etc.
It's a tricky one.
That can be a limiting factor.
So roll out 2 and then go again. Is that? Can you do that?
Oh, you could do that. Yeah, and I mean, look. In recent times, we've been releasing the mum and dad guarantees in 12 to 18 months because of what's happened with property prices in our area,
that's quick.
right? So
explain what that means then. How does it change?
So that means once the property that I'll call it the kids, the first home buyers have bought, can stand on its own, and the loan is at 80% of the value of the property. Mm-hmm. When it gets to that, we just revalue the property and then we release mum and dad, the second mortgage on mum and dad's home. Yeah. And that means mum and dad are free to move on. They're no longer tied to that transaction, so to speak. And so, typically before prices started going crazy in COVID, that would be a 4-5 year kind of plan. And I would always think allow that kind of time span. We're not going to see the growth that we have seen over the last, I wouldn't expect over the last 6 years in our region, but I'm positive we'll still see more growth, right? So
100%.
The region's good.
It just might be a bit of, look, we're not going to just have positive year in, year out, right? There's going to be some areas where it's flat. We might see modest drops through cycles as well, which we've seen before. Yep. I mean, obviously the GFC was a bit of a shake-up. We saw 20, even 30% drops around the Tweed. It was sort of approximate.
Yeah.
So, look, things do happen too. But, at the moment, I think there's a lot of stability in the economy, like you said.
Yeah.
What's your biggest concerns with the budgets? What's your biggest concern that the Labor government are going to do to us, mate? What do you reckon the worst could be?
I think the worst would be if they totally remove negative gearing. I think that's going to affect the willingness of investors to bring new property to market, right? And so there's already enough challenges with that as it is. So, I mean, I don't know if you saw the HIA last year did a report on how much of a new home, for example, is tax, and it was like, depending on the area, 50% of the new home build and land acquisition, including stamp duty, is government tax.
Oh, wow.
So that's all already.
You're getting good whack there.
Oh yeah, it's pretty good. They spend a lot too, right? So they need to keep the habit up. So if they take away the negative gearing, it just disincentivizes people to bring new investment properties to market. And so all that does is forces prices upward, rents upward. It's not a great cycle to get into. So I think that would be my biggest concern. They might change it somewhat, take it back to what it was in 99 or whatever and have it pegged to inflation. I don't know whether that'll be helpful or not. So, but that's a concern.
Had a good question from the audience actually in regards to, young people starting out, flipping their properties every 12 months, capital gains free at the moment. I believe that's the way it's pretty consistent there as long as it's your principal place.
Yep.
Do you think there's any concerns there? That was a real red flag they were worried about.
It's not something that they've mentioned that they would play with the principal place of residence, capital or being free of capital gains tax. That'd be pretty disappointing, I would say, if that came in. So I would expect they would leave that untouched. So what about you? What's your concerns about the budget?
Yeah, good question. I definitely think the capital gains tax for investors, I mean, like you, we represent, close to 500 investors in the Tweed, and I know that a lot of them have been concerned about that, some of which have even been concerned enough to consider selling their properties. I always say, look, whether I'm a director or not, I'm a real estate agent by default. If I'm asking and considering that, unless your situation is to downsize, your asset pool and go into a retirement age where that suits your needs. Like I've got investors that have still got property at 80 and 90, right?
Yeah.
So unless you need that liquidity or you're gifting it to the kids or grandkids or whatever you're doing, I'm like, just hold.
Yeah.
The best time always to make decisions on things is to sometimes when everyone else is making a decision that could be a negative decision, like selling too quick right now could be the worst decision, hold.
Yeah.
And certainly if you're going to sell and if you've got a strategy to sell, I always say, look at it as a 5 to 7 year plan. No one ever picks the top of the market, but look at it when it's moving really well. Release your equity then, get a great result, and have a plan in place, with your agent, with the business owner, with how the property is going to, maybe it needs some updates. And at the moment with the negative gearing, get the claim tax deductible offsets, get all the benefits first. Then the property is in a great, position. You're not floundering last minute, getting it painted, doing titivating, having period with loss of rent. A lot of those tasks can be done while tenants are still in play, and then have an exit strategy. And I always say that to people. What's your end game? What's your time frame? Is it you're just freaking out about, which is, hey, I freaked out about some of the things they're saying too, right?
Yeah.
But are we acting based on fear, or are we acting based on what the best scenario is for you? And it's amazing how many landlords have gone, really appreciate the advice. We're just going to let the dust settle, and then make some decisions in the next end of financial.
Yeah. I think that's pretty sound advice. And do you know what we find too is as a natural kind of habit, we find leading up to an election or a budget, people just sit on their hands. Like a lot of people will literally go, I had this plan, but now it's close. Yeah. I'm not going to do anything. I'm just going to wait and see. And funnily enough, it happens. Elections run and won. And then they go back to exactly what they were going to do in the first place.
And nothing changes.
Right? It's like, so it's interesting watching human behaviour as these events crop up, and then we work past them, and it's almost like, no change.
Even the psychology of this budget, like there's this big ramp up to it, and it's Armageddon. The world's going to come to an end. All these taxation rules are going to apply, and all the rest of it. And at the end of the day, I even look at the superannuation scenario where, potential capital gains tax implications over $3 million. And at the moment, that's per person, by the way. Most people don't have over $3 million in their super fund. So it is a concern in the future, and I think it's definitely a concern for our kids more so, and definitely our grandkids. Looking forward to those days in the future, Todd. But right now, I don't know about you, but $3 million for the average person in super is probably a long way off. And look, the people that have probably got $3+ million are probably they'll either diversify and downsize that money, or they'll grin and bear it, because at the end of the day they'll sell something in the future anyway. It's just an early payment of tax, really.
Yeah, that and you know, I feel that those same people with 3 million super are the same people that have the 3 or more investment properties, and everything is structured already accordingly.
Yeah.
You know, they're not owning those properties in their personal names, so the CGT or capital gains tax is not really applicable anyway, because they're operating under those company trust structures. So it's a small percentage of the population, but they seem to get the most airplay, it seems. So,
that's right.
Rather than, you know, the bulk of average punters in Australia. So
that's exactly right. Yeah. I don't think anyone's really worried about those at this stage. But I guess, look, Todd, thanks for having you on board, and looking forward to our next catch up, mate. We'll have a couple soon with the budget and a few other things come into play.
Yeah, thanks. Hey, it's been great, good fun. So covered some good ground, I think. So yeah, thank you.
Cheers.